So the big question is, are we going to see a bull market ahead or a bear market? And we are getting mixed signals. So the RSI at 55 is saying bear. The 4-year cycle, being 1.5 years after the halving, is also saying bear. On the other hand, stock to flow, the valuation says bull ahead, and the moving average realized price also point to a bull market.
For the first time this cycle, PlanB, the analyst behind the Bitcoin stock-to-flow model and one of the most consistently bullish voices in the space, is openly acknowledging that Bitcoin may already be slipping into a bear market, not because of price alone, but because of a clash of indicators that rarely appear at the same time. In his latest analysis, the Relative Strength Index has broken down to 55, a level that historically preceded deep drawdowns in 2014, 2018, and 2022. At the same time, we're a year and a half past the halving, a point in the cycle traditionally associated with late-stage euphoric tops, not the sluggish, unpredictable price action we're seeing today, and that unpredictability has defined the past week. Bitcoin is now trading in a narrow and uncomfortable band, repeatedly rejected from any attempt to reclaim bullish momentum. Liquidity remains thin, on-chain accumulation has stalled, and volatility has collapsed to levels we haven't seen since the 2020 pre-bull lull. Ethereum continues to lag, meme coins have cooled off sharply, and even the strongest narratives of the year, AI crypto convergence, tokenization, real-world assets, have failed to produce sustained upside. For many investors, this isn't the explosive post-halving bull run they expected. It feels more like drift, confusion, and contradiction. And that contradiction is exactly why today's video matters. Because while some of PlanB's metrics point toward a bear market, other metrics, including his stock-to-flow valuation bands and realized moving average models, still show room for significant upside. That's why we're not stopping with PlanB. We're also bringing in analysis from Fundstrat's Tom Lee, whose on-the-ground macro view at Binance Blockchain Week paints a completely different picture of what comes next. By the end of this video, we'll piece together what these experts agree on, where they diverge, and what it means for the future of Bitcoin and digital assets. Before we dive right in, please hit the like button, subscribe to the channel, and turn on post notifications for more insightful analysis. Thanks for the support and enjoy the video.
RSI. It's at 55. That's a big dip from 65, but it's still in an uptrend. It's above 50. Everything above 50 is uptrend. Everything below 50 is a downtrend. So it's not overbought, the red area. It's also not oversold. It's a bit in the middle, but it's still a big dip. And last video, I said that I would be worried if the RSI dips to 55. Well, we are at that point right now. So in my opinion, there are 3 scenarios from here. First scenario, like 2014, we'll have a bear market. Or 2018, when it was at 55 as well, bear market followed. Or 2022. RSI was at 55 and a bear market followed. That means a minus 50% drop from here to below the 50,000 level. That's what this could mean in scenario 1. Scenario 2 is that it's like 2019. So we had a sort of pre-bull market, a fake bull market, and then it dipped back to below 55, and then the real bull market started. So it could be like that. This could be the fake bull market, the pre-bull market with the euphoria around ETFs and the election of Donald Trump and the end of the war on crypto by the Democrats. But yeah, that's scenario 2. And that would mean that the next step would be a bull market. So after the blue, we had this fake bull market, bear market. Now we get the real bull market, the red. Now, the third scenario is that this time is different. That this time the range of the RSI will be between 75 and 55. It will stay there. It will stay like this. and we will see no more red and no more blue. Which scenario we will see, I don't know, but I lean towards scenario 3.
PlanB's clip ends with his preference for scenario 3, a new RSI range where Bitcoin oscillates tightly between 55 and 75 rather than entering a traditional bull or bear market. The reason, in his view, comes down to how dramatically the market structure has changed. Retail investors historically bought lows and sold highs, but institutional investors, the ones now driving the majority of flows, operate differently. They manage exposure, not emotions. If Bitcoin rises too fast, they are forced to sell to rebalance back to their target weight. If Bitcoin falls, they must buy to restore that allocation. This automatic rebalancing, buy weakness, sell strength, suppresses volatility and can trap Bitcoin in a controlled, almost mechanical range. PlanB argues that this dynamic is already visible on-chain, and it might explain why Bitcoin has repeatedly failed to break out or break down. But while PlanB sees this range-bound structure as the new normal, Tom Lee interprets the same period very differently. In his view, the weakness since October 10th wasn't the start of a bear market. It was the final flush of leverage from the single largest liquidation event in crypto's history. And now, with market makers returning, deleveraging nearly complete, and institutional inflows strengthening, he believes Bitcoin and the broader crypto market are positioned for a sharp recovery. So after examining PlanB's caution and institutional flow model, we move to Tom Lee's thesis, one built around macro catalysts, structural demand, and the belief that the real acceleration is only just beginning.
In December 2016, you could have said, I want to own the S&P, and you would have tripled your money, which is pretty good. You could have bought gold, because you might have been a gold bug and you quadrupled your money, or quadrupled your money. Or you might have been really smart and bought NVIDIA and made 65 times your money. But if you bought Bitcoin 10 years ago, which is right around the time we started recommending it to FundStrat clients, you had 112x. But outperforming Bitcoin was Ethereum, which was a 49 times return. I'm sorry, 500 times, almost a 500 times return of your money. So that was the last 10 years. Now we're in 2025, and when I look back at what happened this year, we've had a lot of major positive fundamental events, but the price action's been terrible. So here are some high-level bullets of what I think have been the high points. The first is the US government became very pro-crypto and setting the standard for the Western world. The second is several US states and the US government plan or have executed a strategic Bitcoin reserve. Huge deal. The third is that BlackRock's Bitcoin ETF is now their top 5 highest generating generating product for BlackRock. I mean, think about that. They launched that only a year and a half ago, and it is one of their most profitable ever ETF products. Now, JP Morgan, which, as you know, has been a hater of crypto for many years, is launching a JP Morgan coin on Ethereum, but they're not the only ones, there's others. Tokenization has become a big buzzword and priority for all these major financial institutions. And then these last two things are probably more important than you realize. There have been probably three breakout products that are crypto native that have changed how traditional financial markets make decisions. One example is Polymarket, which really used prediction markets to actually generate so much information that, I mean, at FundStrat, I think it's the closest thing to a crystal ball. And then Tether has proven to be the top 10 most profitable bank in the world. I mean, think about that. It's a crypto native, singular line, monoline business, and it's one of the top 10 most profitable banks in the world. Okay, but I think the real story in 2025 is tokenization. It all started with stablecoins, and that was Ethereum's ChatGPT moment, because all of a sudden Wall Street realized that if you just tokenize the dollar, you could make a lot of money. But now financial institutions are saying tokenization is going to transform finance. In fact, Larry Fink says it's the biggest, most exciting invention since double entry bookkeeping. I mean, first of all, I don't know if that's that exciting, but it is apparently a huge deal. And I mean, this picture is, this is monumental too. Brian Armstrong and Larry Fink together talking on DealBook. Okay. So if you're bearish on crypto or you think the best days are behind us because of the last 10 years, I'm going to disagree. Keep in mind today, there's only 4.4 million Bitcoin wallets that have more than $10,000. Okay. By contrast, there's almost 900 million individuals around the world with more than $10,000 in their retirement accounts. If Bitcoin were to be held by all these accounts, that's a 200 times increase in adoption. That's still, to me, exponential and hypergrowth. Bank of America Fund Manager Survey still shows 67% of fund managers have zero allocation to Bitcoin. Wall Street wants to tokenize all financial products. And keep in mind, financial products today, if you include real estate, you know, it's almost $2 quadrillion that they want to put onto the blockchain. And then, of course, in the agentic world, it's going to create a need for decentralized trust and security, of course, which is what blockchain solves. So to me, I think the best years are still ahead. So let me explain to you why I think crypto prices have bottomed. First of all, crypto is acting like there's a crypto winter because gold's up 61% year to date, S&P's up almost 20%, and you can see Bitcoin and Ethereum actually are negative year to date. And I really like this article by Jeff Dorman at Arca, who said, "The selling that nobody can explain." I think many people can say why they think crypto prices have fallen, but nobody really understands why. But here's what I just want to point out. This is Bitcoin's year-to-date performance, and Bitcoin was having a good year until October 10th. After October 10th, a lot of people tried to explain why crypto is declining. It's the quantum risk to Bitcoin, crypto winter starting. I have so many traditional investors telling me that's the only reason. They say, "Tom, it's the 4-year cycle." Of course, we had the October 10th liquidation event, the biggest liquidation in history. A lot of people say it's the AI stocks have captured mind share. MicroStrategy recently said they might sell their Bitcoin. That scared some people. MSCI may exclude digital asset treasuries from indexes. And of course, Tether got a ratings downgrade. So maybe some of these could explain why crypto's down. But just keep in mind, crypto was up 36% until October 10th, and then it's gone straight down. I personally think it has a lot to do with deleveraging. And as you know, after the FTX collapse, it did take 8 weeks before market makers recovered and crypto could start to see price discovery again. And we're basically 7.5 weeks past that event.
What's striking about PlanB and Tom Lee is not that they disagree, experts often do, but why they disagree. PlanB is essentially saying the market is entering a new structural era, one defined by heavy institutional flows, disciplined rebalancing, and a technical range shaped as much by risk management as speculation. In his view, the old boom and bust rhythm that retail traders built their expectations around is giving way to something more controlled, more stable, and more difficult to interpret using traditional cycle logic. If he's right, Bitcoin's next explosive move won't come from hype. It will come from a slow grind of accumulation as institutions quietly tighten their grip on the asset. Meanwhile, Tom Lee looks at the same market and sees something entirely different. He sees a crypto ecosystem that just survived one of the most violent deleveraging events since FTX and is already recovering. To him, October's crash wasn't the beginning of a bear market. It was the final shakeout. And now, with policy tailwinds, tokenization exploding, Wall Street fully engaged, and adoption still 200 to 1 below its potential, the setup is not cautious, it's asymmetric. It's the kind of environment, historically, where Bitcoin catches the market sleeping, breaks out when sentiment is at its lowest, and then forces everyone who sold at the bottom to chase a breakout they didn't believe was possible. So what happens next? The truth is, both analyses can be right at the same time. The market could stay range-bound in the short term as institutional rebalancing keeps prices contained and still be setting up for one of the biggest upside surprises the sector has ever seen. If institutions are now the ones buying every dip and fundamental adoption is accelerating, then this calm period might not be a top. It might be a pressure buildup, a coiled spring, and that's why now is the time to pay attention, not to the noise, not to the weekly candles, but to the structural shifts happening beneath the surface. Because when this market decides to move, it won't give anyone a warning. And drop a comment below. Do you agree with PlanB's new normal? Or is Tom Lee right about an explosive recovery? If you found this breakdown helpful, make sure you hit like, subscribe. Let's talk about it. Thanks for watching and see you in the next one.